Good afternoon, ladies and gentlemen. Welcome to yet another investor update from Mayberry. My name is Dan Theok, Senior Vice President of Investment Banking, and I'll be your host for today. Similar to our weekly investor updates, these briefings keep investors and the general public up to date with key companies listed on the JSE. Today we'll be doing it a little bit differently, but we'll be bringing you Mayberry's Q3 results. Our Executive Chairman, Christopher Berry, and our CEO, Gary Parrott, will be joining us today. Welcome, Chris. Welcome, Gary.
Hi, Don. Hi, everybody.
Great. Thanks for being with us. As I said, folks, we're here to share with you today our results for the 9-month period ended September 30th, 2022. If you're a fan of the content, then don't forget to subscribe and hit the bell to stay up to date with the channel. We upload content just like this every week. And that's why if you're looking for your very first investment journey, you should take that first step with Mayberry, of course. So follow us on social media at Mayberry INVJA to learn more about how you can get started today. Okay, great. We want to go right into the results. So as promised, let me begin with a presentation. Okay, first up, we want to share with you 6 key KPIs. First up on the first slide, talk about the year-to-date profit attributable to shareholders of $2 billion year-to-date to September 2022 for the 9-month period ended, which is up by 157%. And naturally, the EPS is also up by 157% to $1.70 per share versus 66 cents per share for the comparable period last year. Additionally, the year-to-date operating revenue, that's up to $5.8 billion, which is up by 193%. And total assets, they're up by 18% to $51.5 billion. Next 2 things I want to highlight is the net book value per share, and that's up by 10%, up to $5.8 billion based on the net book value. And that represents our results, our earnings for the 9-month period annualized represents a return on equity of 12.4%. Last year, same time was 5.3%. So good going job. Good going, guys. Next slide. I want to show you the actual financial highlights and focus on the 9-month results to September 2022. In the quarter itself, we know we had some pullback, but the focus is on the 9 months to September 2022. And for net interest income, you can see that's up to $5.78 billion, up by 193.2%. Operating expenses are up 37% to $1.6 billion, and that results in a profit before taxation figure of $4.18 billion, up 421%. And a net profit attributable to shareholders, given the minority interest in MJE, which consolidates into MIL. The net profit attributable to shareholders is $2 billion compared to $795 million same period last year. That's an improvement of 157%. Other comprehensive income for the period, negative $222 million. And then that results in total comprehensive income of $3.875 billion for the 9-month period, 2022 compared to $2.19 billion for 2021, an improvement of 76.9%. So again, that results in earnings per share for the 9-month period of 66 cents, up by 157%, as we said before, compared to for the same period last year. So $1.70 EPS versus 66 cents, an improvement of 157.2%. Moving along on the next slide, just to show you some of the profitability metrics in a graphical format. Again, the net profit attributable to shareholders of $2.19 billion. You can see that in the green. And total comprehensive income of $4.1 billion. So good going there, guys. Total comprehensive income, $4.1 billion. Net profit attributable to shareholders, $2.2 billion. Next slide shows our operating expense analysis, and you can see in terms of the efficiency ratio, it's about the same, 52.43% versus 51.71%. So they're doing a reasonably good job of managing those costs. The green line shows depreciation and amortization, and the blue bar shows the staff costs. So staff costs, falling slightly from 40.48% to 34.65%. Next slide shows you the financial highlights, summary of the statement of financial position. And here you'll see that we have total assets of $51.5 billion compared to $43.6 billion, so 18%, $7.9 billion improvement in total assets. Total liabilities, 25.619 billion compared to 23.213 billion. So that's a 2.4 billion increase or 10%. So we're growing our assets faster than our liabilities. And as a result, you can see here our equity is grown to 16.55 billion from 15 billion. That's a $1.5 billion improvement or 10% improvement. And total equity up to $25.98 billion versus $20.398 billion, an improvement of $5.5 billion or 27%. So net book value per share, 13.78, up from 12.53, an improvement of 10% or $1.25. And the note is speaks to main performance drivers. We speak to the growth in assets base primarily as an increase in the investments in the MJ portfolio, which grew by about $6.2 billion as it relates to associates. And then we also mentioned intangible assets, which increased by $342 million compared to 2021. And I think that relates to our new digital platform and all of the IP that we're capitalizing in relation to that new technology that we're implementing, which is going to help grow the business and improve our efficiency going forward. Also, we note that at September 30th, 2022, the group's equity was $16.6 billion, up from $15.1 billion, and retained earnings increased by $2.3 billion, driven by the $1.5 billion year-over-year growth. So good going there. Next slide again shows graphically what's happening with the total assets and liabilities and shareholders' equity, which we pretty much just discussed, but it's sort of good to see that growth graphically, and they're showing you that growth over a 3-year period. Next slide. Wanted to look at the main market as at 2022, various stock prices, the earnings per share, and more importantly, the PE ratios and the price to book ratios. And what is important to note here is that in general, we've talked about how the main market average PE has been pulling back, and the main market, our mean average is about 10 times. But in that, you do have some that are unusually low, and I want to say that Mayberry is one of the lowest with a 2.78 PE ratio is very, very low. Compared to other financial sector folks where we see sort of a mixed bag from anywhere from like proven at 1194, focusing mainly on the financial sector companies, to a JMNB, which is also very low, unusually low at 638, to others like VMIL at 13 times, or Scotia at 12 times, or NCB at 9 times, or even Berita at 29 times, or SIL Sterling at 20 times. So I expect, as we go forward over the next year, interest rates will, continue to be high. I think for the next 6-9 months, PE ratios will continue to be compressed, and I think you're going to see more folks pulling closer to the 10 times average. So for the stocks which are trading at 20 times or higher, I would consider that to be something trading rich, and you're going to see just normal supply and demand and good investment sense prevailing, and you're going to see I believe you're going to see those PE ratios tightening up. So the main market average could still stay at 10 times. The hope would be is people would get wise and buy the stocks that are relatively cheap, like MIL and JMNB as an example here. And then the stocks that are trading relatively rich, I would expect to see those pull back. And it's also important to look at the combination of PE and price to book. So again, the main market average price to book is about 1.2, 1.3 times. And so again, we can see where, for instance, MIL Mayberry is trading very cheap at only 0.56 book. So the stock price, the share price is below the NAV if the price to book is less than 1, right? And so that, again, that speaks to an opportunity for a good buy. And we see there where most of the main market financial sector stocks, like I say, tend to trade a little bit above book. 1.2 times is the average. And we can see, for instance, Scotia at 1 time, NCB at 1.4 times, and again, VML at 2.2 times. And the guys who are trading relatively cheap would be on a book basis, certainly Mayberry, Cygnus, First Rock, on a book basis. But you want to take both book and PE into consideration, and it's blatantly clear that MIL is trading cheaply, both from a PE ratio and from a book ratio, and that's a little unusual for the market. And I'm going to predict we're going to see these things correcting over the next year, and I look forward to coming back and having that conversation. Price versus book on the next slide, I think, shows up again. Again, wherever the green line there being the book value and the blue line being the share price, and wherever you see the share price below the book value, that's usually suggesting to you a great opportunity to buy a stock. And if you then go and do your second check and see that the PE ratio is also trading relatively cheaply, then that's something you really want to look at. So there's definitely an opportunity there. What you can see here is that the book value, which is again shareholders' equity or total net assets, you can see in Q3 2020, which is in the sort of middle of the pandemic, the start of the first year of the pandemic, you can see where Mayberry stock, as many others did, fell from 12.49 to 8.29, the NAV, I beg your pardon. And then you can see how they've built back up that NAV to 12.53 by Q3 21 and now 13.78 by Q3 2022. So the book value has now exceeded the pre-pandemic levels, and yet the stock price has not quite gotten back to pre-pandemic levels at $8.13 compared to when it was at $8.87. So once again, I'm saying, folks, there's a great buy opportunity when you look at the Mayberry stock and look at the growth in earnings, the growth in the NAV, and what's happening with the EPS as well too. Next slide looks at sort of the estimated value sort of proposition. And this, Gary, can you see this slide? This is a slide that I know Gary can speak to more authoritatively than I can. Hey, Gary, can you see that slide?
No, I'm not seeing that one. What does it say?
Oh no, and that's the one that shows the value versus the share price, and again, it's just the idea that our stock price is at 18 and the value is clearly closer to $27 when you use a typical PE ratio type adjustment to where we think the stock should really be.
Yeah, well, I mean, we have spoken about that on a variety of occasions, Dan. And I always finish by simply saying, the longer it stays like that, it's the more people should buy the stock, because when it changes, there'll be significant value to be had by those who bought the stock.
Yes, absolutely. And then the very last slide in the presentation, guys, where we look at the net book value, very last slide in the presentation, if we could just jump to that, we tend to look at the net book value plus cumulative dividends. It's the idea that this is a stock that pays good dividends, Gary. And when you factor that into consideration as to, it's even a better buy, because we do have some stocks out there that, while they're giving you some capital gains, you're not getting any dividends. So, for instance, traditionally, Carib Cement has not paid dividends in over a decade, although it's given reasonable growth in terms of the capital value. Or Carreras hasn't seen much capital gains in the last 4 years, but it's a good dividend paying stock. With the Mayberry stock, we're saying you actually have the potential to have both. You're going to get good dividends, and the growth is going to come when you look at the key metrics. Your thoughts on that, Gary?
Well, yeah. I mean, so what you've seen is that you've gotten a reasonable dividend from Mayberry, despite the market not recognizing the growth. The growth is still there. And the simple reality, we've come through COVID. And we've come through COVID without any material deterioration in the numbers. And we're now moving away from COVID. And I think one of the things you should look at, which is another important ratio, is that Mayberry has one of the lowest leverages in the company in terms of capital to assets ratio. And what that means is that, whilst you're in terms of, for the regulatory ratio minimum, you're overcapitalized, which is good. It also means that you're under leveraged. So as you come out of COVID, where during COVID you wanted to make sure you had cash, all is well, because you didn't know what was happening with your customers and ultimately yourself. We're now coming out of COVID, and it augurs well for us at Mayberry, because we can take on significantly more debt and ultimately get more capital to deploy in a profitable way. So if and when we do that, those earnings will start to move again in a material way. So what it says is that for all of those people that still haven't taken advantage of the stock in the past, the opportunity is there. But there will come a point, as it happens with every stock that has been in this position, where the market will recognize it, and you're not going to see the stock move by 10 cents, 20 cents. It's going to gap up by $5, $10, etc. once people start to see that.
Absolutely. And my next question is to you, Chairman Barry. I mean, it really is impressive, the growth that we've seen in the assets under management. I just want to, take a peek at MJE. I watched this, stock and the portfolio 7 years ago when you only had $12 billion of, assets and $2 billion of debt. And today you got, $23 billion of assets and only $3 billion of debt. So to Gary's point, the business, the group is using very little leverage, but you're still growing the portfolio in an amazing way. It makes me wonder what potential the business has if you put a little bit more leverage on it. But just tell us about your investment philosophy in general and how you've managed to grow this portfolio, by over $15 billion in the last 6 years.
So Dan, we focus on three things: management, scalability, and those two things are what we focus on. Good management and scalability. And I think so far we picked right, and we're gonna continue to invest in the good Jamaican companies that have good management and good scalability. And the great thing about MJE is we're just coming out of a board meeting today, and we're talking about how do we get our clients to have a similar experience when dealing with the company. And that's one of the great things about MJE. That's what we invest in. So it's a vehicle that our clients can easily invest in and have the same experience that we're having. So that's where our money is, and we're gonna do our best to make it grow.
Yeah, and it really is impressive, and I do like the fact that Mayberry is always doing sort of these, great initiatives, and then we see the market trending to follow. So as an example, you created the MJE portfolio, which is pretty much an ETF or an equity traded fund. You've grown it to $23 billion, over $13 billion in retained earnings, and then many years later you see Sagicor Select F, a Sagicor Select M&D, and then a QWI. And I sort of go back and take my notes. I add all three of them up, and I say when you add the three of them up, they've got maybe 13, 14 billion in assets, maybe 5 billion in equity. And so you've got twice as much equity as those three other funds combined. So it really is impressive what Mayberry is doing over there. Chairman Barry, one more question.
Well, if I may add,
go ahead, Gary. Absolutely.
If I may add, I think one of the things people miss, which we spend a lot of time on, is that we have been picking resilient companies. So if you look on, for example, CPJ, there were many people, you could even argue some of the same people at CPJ themselves, at the start of COVID, that thought that, hey, this company was on its way out. In the stock traded down to $2.50 down.
$2, yeah.
And, we thought that this was a great opportunity, that shows the breadth of Mayberry, because that company benefited from some of the IP of Mayberry. And when we turn around a year or two later, this is a stock that traded all the way to 24 and has now settled at 13. That's significant value creation. Some other investors would have dumped the stock at around $2, $2.60, but Mayberry was there, and we stood by it, and it benefited significantly. I mean, then there are other similar questions. Some other companies, Lasco Financial, when they were having their challenges with the microfinance side of the business, there are some people who wanted to throw it overboard, but we stuck with it because these are resilient companies that can take advantage of certain opportunities in the country. So 2 years ago, a CPJ on the way out. When you look at it today, there are 6 hotels with about 6,000 rooms that's coming on board. That's a business that's poised for significant growth. And so you might argue $13 is undervalued. We can talk about many other companies in the portfolio, the SVLs, etc. I just spoke about Lasco Financial. And, what you're seeing is Jamaica has come out of COVID in a good place. The fiscal numbers in a good place. I mean, we're seeing small nations like ourselves fighting this inflation, this imported inflation, and have depleted their NIR. We have done that, and the NIR is still solid. So we're set for growth. We have these companies in MJE that's also poised for growth, which means that the Mayberry Group will continue to grow. So if your core is growing, you've made a point a while ago, the group is on the leverage. I mean, there's significant opportunity right across the board, not just equity, but also in other areas of the business that we will continue to do well.
Yep, absolutely. And when I think, I don't often quote someone like Wayne Chen, but I was impressed when I saw it, speaking about the fact that there's probably no other country in the hemisphere, or was it maybe Minister Clark, that can boast of having the level of low unemployment, growth, and productivity relative to pre-pandemic and post-pandemic levels. So whilst we do have the headwinds of inflation and interest rate, at the same time, we are seeing our debt to GDP, unemployment, and GDP in absolute terms at pre-pandemic levels already. And with interest rates, I think, set to peak over the next 6 to 9 months, I only can look forward to Jamaica continuing to reduce its debt to GDP, creating more fiscal space to invest in infrastructure and other GDP positive producing initiatives. And I think the future is actually quite bright for Jamaica. But of course, we need to get through the next 6 to 9 months of sort of higher interest rates. Now, Chairman Berry, when you think about higher levels of interest rates for the next 6 to 9 to 12 months and how that could impact PEs, how is that resting in your mind in terms of your investment strategy generally? And how do you feel about the next 12 months for Jamaica, for MIL, for MJE?
That's me, Dan?
Yes, Chairman Berry, yes. How do you feel about Jamaica for the next 12 months, MIL and MJE?
So the inflation, I think, I don't really have a good window into that. We never had a pandemic before. We never had 2 years of lockdown before. So we don't know how long this inflation is going to really last. What I would say to you is that I think the central bank has a very clear idea of what high interest rates are in Jamaica and the effect that will have on the economy. And, our next election is scheduled for 2025. And although we have an independent central bank, I'm sure that there's going to be people whispering in the ears of the BOJ. Are you seeing me there, Dan?
Yes, I am.
Dan, are you hearing me?
Yes, I am.
Yeah. Yes, as I was saying, I'm sure there's going to be people whispering in the ears of the BOJ about having the economy moving before the next election. So I'm not worried. I think we're gonna have higher interest rates, but not high interest rates. I think that's where the BOJ is going with this. I think they're concerned about people moving from J dollars to US dollars. And once they see that that's not happening, you're going to see them pull the pedal back off of the interest rates, because they definitely don't want to kill the economy. The last thing they want is a recession. And so they're not going to do that. I don't see them doing that. So I think everything's going to be good.
Excellent. And Gary, over to you, more specific to Mayberry. Gary, what opportunities do you think this environment, again, over the next 6, 9, 12 months will create, and how do you plan to take advantage of that?
As I indicated, right now the discussion is what's the inflation outlook, and based on my research, the genesis of the increased inflation started with shipping rates, the big jump in shipping rates, and that coupled with supply chain issues, started to push the huge imported inflation. Where we are now, you hear me, Dan?
Yes, I am.
Yeah, I think where we are now, we're starting to see where the freight rates, shipping rates have started to trend down. So that starts the process. And I think that builds into your original projection that you spoke about, that over the next 6 to 9 months, you see interest rates, you know, peaking and it's leveling off and maybe potentially starting to trend back down. I think in that environment, there becomes an opportunity, certainly from the fixed income market. If you can get longer term bonds at a high interest rates and then they start to trend down, it creates significant value. So that's from the bond perspective. If the rates start trending down earlier rather than later, it can then restart certain engines, like, for example, lower mortgage rates, because we're seeing where mortgage rates are going up. Lower mortgage rates leads to more development. That whole positive structure cycle of construction, etc., can be reignited, and also the IPOs, other new businesses starting, and I think there's a lot of opportunity there. From a Mayberry perspective, we have excess capital, so our business of underwriting and finding different structures and continuing doing some of the same stuff that people out there see us doing. For example, one of the biggest opportunities we have is what we refer to as margin lending, because we have a lot of customers that want to take bigger positions in the stock market. And over the last couple of years, I mean, headed by you as well, Dan, we've funded a lot of people who are looking to leverage equities that they had that they didn't normally leverage before. And they're using that cash to either buy more equities or invest in other assets that can give returns. And I think in that environment, Mayberry does very well. So I'm pretty confident in terms of where Mayberry will be, certainly for 2023, for all the different factors that you spoke to there. I think the fiscal will continue to do well. We've been watching those numbers on a monthly basis. The surplus continues to grow. So the question is, where's the ministry going to invest that surplus? Not necessarily in debt reduction. Maybe they have an equity play as a government they want to take. Because what a lot of people miss and forget, is that one of the reasons we got through COVID was that we had $80 billion in cash that was there. It's not that I don't think the minister knew COVID was coming. I think he had a different plan. But he certainly didn't use the 80 billion and pay down debt, and we could have had a further $4 to $8 billion saving on the debt service. So there had to be a plan. I mean, I don't think it was ever interrogated to find out what that plan was. Yeah. But we've knocked on wood, thank the Lord, there's 80 billion that carried us through COVID. Since coming out of COVID, the fiscal has continued, and the surplus starts building again, just like pre-COVID. So maybe whatever that plan was pre-COVID, that plan still maybe is on the cards. I don't know. So we look forward to that. But what it would mean is that once fiscal continues on its current path, there's significant opportunity for growth. And we believe Mayberry will play an integral part, whether on the equity side, whether on the debt side, or even on underwriting.
Absolutely, and I do think the rising interest rates to then be followed by the lowering of interest rates. Any way you look at it, it's going to create huge opportunities for debt restructuring and refinancing. I personally think we're going to have, and take note of this, folks, as a country, at least 9 IPOs or APOs in the next 12 months. I know we have 6 to 8 in the pipeline. And so this higher interest rate regime has more and more clients thinking about raising money from the capital markets in the form of APOs and IPOs. And as you said, the same high interest rate has our clients still wanting to invest more in equities. So, we were forced, because of the increasing our cost of funds, to increase our margin business interest rates by 300 basis points to protect the spread. And lo and behold, we still did $3 billion of additional business in the last, 6-9 months. So I'm encouraged to see the capital markets are still strong. They still have good appetite for good IPOs, APOs, for good bond offerings. So that's a great sign to see that, the capital markets is still alive and well and still quite strong. And I think Mayberry will continue to play a great role in that regard. So folks, look out for for more IPOs, APOs, and capital market transactions by Mayberry, and that's how they protect their net interest income and how they grow the business. And then on the equity side, they're investing in great companies like CPJ in the tourism sector, which is right now back to pre-pandemic levels and growing, as you said, Gary, with 6,000 hotel rooms currently under construction, likely to come on within the next 2 to 3 years. So that's really exciting for companies in the tourism space like CPJ. And then we got other companies I think that are very well poised to take advantage of this interest rate regime, of the need to improve on financial inclusion. So Gary, I want to give you 20 seconds. Surely SVL has a role to play in this place as well too when we think about the need to improve financial inclusion in this high interest rate regime and with the amount of cash that's in our economy.
Yes, they do. And I'm sure at some point you will see there are solutions for that. But we've spoken about the opportunity and potential where SVL is concerned, and in their own right and time, that will manifest itself. I think as Jamaicans, there's an opportunity out there, and getting back to the mantra, MJ is the only stock you need to own. Why go and do the hard work? Have Gary Peart, Dante, Chris Berry, and Matt Berry do the heavy lifting for you. Because as you said, the numbers don't lie. The numbers are very good, and they will continue to be very good. I've always said that Mayberry is very high on Jamaica. We get very high on Jamaica because we think Jamaica has significant opportunity and potential. We haven't yet started to scratch the surface of the potential in the country. And there's significant amounts of money to be made once that potential starts being scaled. So that's where our money is, that's where our principle is, that's where our mouth is. So it's easy. You buy MJE or you buy Mayberry, it's going to create a lot of value. A lot of Jamaicans like real estate, and when you buy good real estate, it will appreciate in value. So Mayberry stock is just like good real estate. So whether that good real estate is in the heart of New Kingston, the heart of Montego Bay, or in Sansan and Mobay, or Billy Dunn, Golden Triangle area, that's what a Mayberry stock is. Buy it, put it down, and it'll be significant value in the future. But all we can do, we can lead a horse to water, Dan. You can't make them drink it. So unless of course you put a little salt in there, but hey.
Okay, great.
Then they won't stop drinking.
Great. So let's turn to social media and take a few questions from there, if you don't mind, Gary. I'll throw one or two up at you. First one up, I think it's really just a comment. The market's a crazy place these days. Even with the beautiful performance, capital appreciation will still be sluggish, and that comes from Alian Wilson. So Ali, and that's why you need to choose your stocks carefully, because the market overall, I agree, is going to be sluggish. But we just pointed you out to the fact that the main market average PE ratio is 10 times. And in that market, you've got some stocks at 20 times, 30 times, and you've got some at 2 times, 4 times, 6 times. And so what you want to do is invest in good companies with low attractive PEs, and I promise to you over time you're going to get great returns from those companies. And we saw 2 great examples in the form of MIL and JMMB. You can close your eyes and buy those 2 companies, and in 3 years' time you're going to make a lot of money, Alian. So that's my advice to you. Next one comes from...
Before you go there,
sure.
Dan, if I could add quickly, the example I gave with CPJ is an example that she can use in the real world. When CPJ was beaten down to $2.50, $2.60, you had some people who were trying to time the market and say, hey, let me sell CPJ and come back at a later date. You sold it, it was there for a couple months, and then before you knew it, it was $4, $6, $7, $9, $13, $20. You couldn't get back the stock. So once you've invested in a good company, there will be dips, but they'll return, and when they return with a bang. And sometimes you can't get in without paying twice the price before.
Very good point, Gary. Okay, next one up from Garvin. Can we get an update on the reorganization of the group and the introduction of the new group company? What's the timeline?
So we're working on the timeline. I mean, of course, we're subject to the vagaries of the court and court filings, etc. And so, as we speak, we haven't yet gotten a date. The moment we get the date, we'll definitely communicate it. At this point, we expect to get a date before the end of the year. If we don't, we'll communicate that as well. But that is outside of our control, and we're trying to do everything we can to ensure that it's done for this year.
Excellent. Next one comes in from Devin. Will we be seeing a listing of any of the SVL subsidiaries? And when can we expect another Mayberry brokered IPO?
So this is a Mayberry investor briefing, so we'll keep the stuff at a minimum. In terms of the IPO, even if it's imminent, we couldn't speak to it because you would have a silent period.
Yeah.
But as Dan says, we expect to have some IPOs in the near future.
Yes, Devin, I'm going to have at least 4 for you, or you can find me. But these things take time, and I think you're going to see some opportunities sooner than you can think. But we've got 4 to 6 ones that I'm really excited about. It's just a matter of waiting till we get all of our ducks in a row and working with the clients to make sure that they're ready to actually go public. But we're going to have at least 4 for you in the near future, one by one. You're going to see them coming. Elaine says the junior market is where the excitement is with IPOs, APOs, and RIs. People are selling off to enter that market, plus chopping stocks mentally. So I do want to caution, there's a tendency to do this, buy and flip thing with the junior market stocks. And what you're finding, guys, more increasingly is your allocation is like really poor. So, what's the point of sending $1 million to try to get, a dollar stock at IPO and you only get 5% of what you want? So whilst there's, a little bit of buzz with the junior market stocks, I still think there are great opportunities, whether it's main market or junior market, to make good money and stick to our principles on the PEs, right? So again, Gary speaks to CPJ. This is a real example because I remembered last year, March, April, May, saying to all of my clientele when the stock was at $3, $3.50, buy CPJ now. This is crazy. We're coming out of the pandemic. This thing is ridiculously undervalued. And, here we are 12 months later, 15 months later, the stock's gone from $4 to 14. I mean, at one point in time, as Gary said, it touched 20, 24. But if you went from 4 to 14 like me, you're up 190%, you're cool. I'm telling you now, guys, that MIL, NCB, JMMB, those opportunities are here again. In 15 months' time, 18 months' time, you all are going to be saying, geez, I wish I had bought me some MIL or some NCB or some JMMB. So look for the good companies trading at relatively cheap PEs and focus on those ones. Okay, David Rose has a question, Gary. On the investment banking side, have some deals been shelved because of higher interest rates?
Well, the simple answer to that is yes. We've seen deals, we've heard of deals that have been parked, not primarily because of the higher interest rates, but in some instances, the inability to accurately predict what it would cost. So we have seen some clients that say, hey, let us wait until everything settles down. So there's some deals that can absorb the higher interest rates. But, for example, we've been going through different liquidity positions over the last 3 months. So BOJ puts out a report that shows the aggregate liquidity in the system. And I believe for October 15 to 17, I mean, the total monies across the deposit-taking institutions was about $5 billion. And that compares to 23 billion yesterday. So that gives you an idea of how things fluctuate in terms of liquidity. So a deal can come to market and there's no guarantee that it will be fully settled, fully sorted out in the period of time that you want. And that uncertainty usually leads to companies saying, let me sit and wait and reassess. But at the same time, we've seen other companies that have gone ahead because whilst the interest rates might be higher now, the opportunity to acquire a business might not be there in 2 years' time or 18 months' time when interest rates are lower. So even if you acquire the business now at a higher interest rate, you can reprice that interest rate in a year, 2 years, 3 years, but you would have still had the company. And at that point in time, if you reprice lower, the value creation becomes significantly higher because of what has happened with that company. So, those decisions have to be made by those principals. If you're buying a business, it's a more long-term type scenario. How you finance it is at different stages of time. So it's every 5 years, every 3 years, and then you're at the vagaries of the market at that point in time. So we look and see.
Excellent. Next one up again from David is, have you seen more demand by clients for short-term fixed income instruments or more private equity structured options?
What I've seen, especially with the variability and volatility of interest rates and liquidity, is A, clients are waiting and seeing. B, clients that would have just financed certain things, wherever they can get the liquidity in terms of debt, they try and get it. Because there's some people who are not really appreciative that the market has changed. But if you have to finance a structure, you have to finance a structure. But business continues, opportunities still continue. But as you must realize, David, there are some deals that, the pricing on it might make sense at an interest rate of 4 and 6%, but, doesn't make sense at 10 or 12%. And that's why we keep saying when you're buying businesses, try and buy sustainable businesses that do well, both in a good environment and also in a hostile environment. Because at the end of the day, if you're going to buy a business and it makes sense to buy it at an interest rate of 8%, but then if interest rates go to 10%, you can't buy it, then hey, there are other issues going on with that business, right?
Absolutely.
So, you have to look into these things, and each of them, they're nuanced. They're depending on your niche. You can make a decision here and there. But overall, I think for any opportunity that's a very good business, people are going ahead with it. But to each his own.
Absolutely. And it's something we've sort of encouraged. I can think of 2 examples of a client wanting to sell and to be at $90. They were panicking. They've got margin. The average price for the stock was $120. And I said to them, look at for 12%, 13% per annum interest rate, I would much rather to wait the stock out for 12 months than sell it today and take a $30 loss. I mean, what's going to cost you to wait another year to see if it turns around? It's a solid company. We know this interest rate regime is going to turn at some point in time. It's inevitable. It's just a question of, is it 6 months? Is it 9 months? Is it 12 months? And that takes me to David Rose's question about, do you expect the BOJ to raise interest rates again next month if the Fed goes up another 75 bips? And, where do you expect BOJ to taper off? And do you think that tapering off is going to happen this year?
Well, for me, the Bank of Jamaica's mandate is to control and manage inflation. I don't think the Bank of Jamaica looks and sees what the Fed does and then decides that that's going to be the integral reason for what they do. Because if that was the case, the BOJ would not have started to move interest rates
so early
as it did. Because they moved interest rates, I think, a full 6 months before the Fed started to move interest rates. I think the BOJ is laser focused on what is happening with inflation. And so far, they have to be given, full marks for how they've dealt with inflation. They had to go through, for want of a better word, the abuse that was meted out to them at times because they had started to move interest rates. And now we see that they should have been congratulated for moving it at the time that they have moved it. So now we're at a level where the BOJ can be looking that it's more likely to taper than to have material or massive interest rate increases going forward. So against that backdrop, I think if you want to have an idea as to what the BOJ is going to do, take a very close look at what the inflation numbers are saying. Knowing BOJ, they're a very conservative group of people, they're going to want to see evidence that it has stopped and is moving in the next direction before, they probably move towards tapering. So they would prefer to overshoot on having a higher interest rate before they're certain than the opposite. So again, watch the inflation data, and I think that will give you your big signal as to what the BOJ is going to do.
Yep, I agree with you wholeheartedly. And what we've also seen in the sort of financial markets is when we're raising money in the US dollar market, it's a very different market than when we're raising money in the J dollar space. And so the US Fed rates and adjustments might affect our US dollar raises, right? Because you have some folks who are just, I'm investing in US, I like US bonds, and that's it for them. And no change in the Jamaican interest rate is going to get that guy to switch from a US bond to a Jamaican bond. That's just the reality. So I think the US Feds impacts the US dollar bonds a lot more. And I think on the J dollar side, what the BOJ is doing is they got early on the brakes, and that's driven up cost of funding for a lot of folks. That's raised certainly, 90-day BOJ Treasury yields, 7.5%. Highest it's been in, a decade. And so I think I totally agree with you, Gary, that there's not going to be much relationship between what the Fed's doing, what the BOJ is doing in that regard. The BOJ, as you said, is laser focused on checking inflation, and we see that inflation is starting to check. And we also believe the drivers for inflation, which were unrelated to the capital markets, primarily the cost of transportation. We see where those costs are checking. We see where the exchange rates slowed down and the NIRs being intact. So I really do think over the next 3 to 4 months, as we continue to get that inflation data in, we're going to see inflation consistently in the single digit region, barring any other, world natural challenges, natural disasters, etc. I think we're going to see inflation coming down, and you're spot on, Gary. As soon as we see inflation getting back closer to that 6% to 8% space, 6 to 8%, then I think the BOJ can really start to take their foot off the brakes. So I'm looking forward to lower interest rates in the next 6 to 12 months as inflation comes down. And I think that's just going to light up back the equity market. So, you spoke about people trying to time the market. I think the timing is now, guys, because the market's also forward looking. As soon as the market perceives that the high interest rate regime is over, we're going to see those PEs going back up. And the main market PE average, which is now at 10 times, I bet you it's going to be at 12 times in the next 6 months. And the junior market PE is now at 16 times. That's going to be back at, say, 20 times in the next 6 months. So there's 20% natural gain that's going to happen. Larger gains with the off-liers who are trading ridiculously low, like ML and JMMB for sure. Great opportunities there. I think we have time to take 2 or 3 more questions. One coming in from Blue Collar Finance. Don't you think BOJ is using the policy rate to control exchange rate movements also? So yes, I think we implied that in the sense that they're mopping up J dollar liquidity and trying to prevent folks who are thinking of asset class opportunities from speculating and wanting to go into the US dollars. And they're doing a very good job of mopping up excess liquidity. But I think their primary objective is to try to check inflation. But yes, if they get the two-edged sword benefit of checking exchange rate movement, then great. And we've seen that. We've seen that the NIR is being protected, that they haven't had to intervene in the market, the exchange market too often. But I think their main focus really is trying to mop up excess liquidity. We've seen them take other measures towards protecting the dollar, right? We saw the restriction of dividends by FIs owned by foreign institutions. We've seen a check on capital exempt distributions in US dollars, where you have to get BOJ approval to do US dollar debt raises above a certain threshold. So we've seen them being more direct in their ways of checking that blue collar finance. But yes, I do agree the high interest rate regime does have that sort of side effect benefit. And then imagine that debt to GDP is coming down substantially. And so the US dollar component of the debt obligations, which puts pressure on exchange rate, and tourism is returning back to normal levels. So, all of the macro signs suggest that on the supply side, we're going to see more foreign exchange coming in. And so they'll have less demand side management measures that they have to take. From Garvin, what benefits will come from the reorganization apart from the alignment of a new regulatory framework, Gary? Garvin's asking what additional benefits will come from the reorganization apart from just the alignment and the new regulatory framework.
Well, that's the biggest thing. So the group has all the subsidiaries that doesn't necessarily have to come under a regulated authority. And so what the realignment does, it puts squarely the regulated entity, which for want of a better word, I'd refer to as Mayberry Jamaica, under the scrutiny of the various regulators. So therefore, they have no issues when they want to do whatever they want to do. And then outside of that, there are other subsidiaries in the group that might be engaged in certain activities that doesn't necessarily fall under that. So overall, I mean, the first benefit is that it's from a regulatory perspective is much more transparent. And then also from a shareholder perspective, it reduces the risk associated with other businesses.
Good deal. And that sort of leads well into another question. One reader says the MIL Group has more than $1.3 billion in cash resources and $2.78 billion of cash and cash equivalents. Does MIL see any deals on the table which look attractive in the private or public space?
We're always seeing deals. And, but what people need to remember is that, whilst MJ is the star of the group at this point in time from an equity perspective, Mayberry has many other product lines and facets. So we buy and sell foreign exchange as part of our Cambia business. We do investment banking. I mean, Dan and his team are doing pretty well there. And on the investment banking, we raise debt and equity for a variety of different businesses and structure a variety of different businesses. But we also have a markets and trading division that buys and sells fixed income bonds and trades fixed income bonds. So we use our cash across many different asset classes. And again, whilst as a business, we're known very well for our equity side, when you look at our number, we generate significant amount of revenue from trading in foreign exchange and fixed income. So there are always many deals across all of those different product lines. And our issue is, which are the ones that gives you maximum benefit, and we put our money there.
Yep, absolutely. And even with, $2.78 billion, the opportunities, out there are just amazing. So I really do think it is a buyer's market. So David Rose asked, would I view this market as a buyer's market? I think yes, there's great opportunities for great buys out there because a lot of folks are sitting on cash. They feel like the recession may be coming and they're sitting on cash. They're afraid of the high interest rate regime, which will be temporary. And so I think, a lot more folks are just parking their cash in 90-day BOJ Treasury bonds, earning 7.5% and saying, hey, let me just wait for this storm to be over to time the market. And while they're doing that, we see stocks that are falling to unusually lows, 5-year lows for NCB, JMMB at the lowest PE ratio I've seen in a decade. MIL at a ridiculously low PE. So there are absolutely great buy opportunities out there right now, and I think it'll be like that for the next 2-3 months. And by the time we see the BOJ adjust the interest rate or see the low inflation lever pop up, it'll be too late. And then everybody will be hoarding back at the stocks and they're going to drive it back to value. So I really do think, yes, David, now is a great buyer's opportunity. And you should try to take advantage of that. And equities, we mentioned this on a previous program, in terms of asset class, I think creates the largest opportunity at this time. So, commercial real estate, residential real estate, you got to be very careful right about now. Bonds, we think those interest rates are going to change in 6-9 months. But when you get a 7.5% U.S. bond or 12% Jamaican bond, I assure you inflation is going to eat up most of that anyways. So equities are where you have the greatest opportunity right now. And as the high interest rate regime tapers off, you're going to invest that money in a 1-year bond. And in 1 year's time, when that bond renews, all of the stock prices are up on you, and the bond interest rates for your next renewal are much lower. So now is the time to speak to your trusted advisor, look for those opportunities in the equity space, and make that investment now while the opportunity is there, because you're going to come back next year after your safe period and see that the market's up on average by 20%. That's for sure. and you would have earned 8% on your safe money that you parked for a year. So I think now is a good time to be looking to make those bold moves, safe, but bold moves. Now is the time to make those moves because the market's definitely sort of in a pullback mode. And I think it's going to be that way certainly for the next quarter. By the time we start to see the earnings results and we start to see the things, everyone's going to rush to the market at the same time and the values are going to just go up overnight long before you can buy any reasonable volumes of the stock.
Well, if I may add to your point, Dan, David and the rest of the viewers out there, one of the things you've always heard of sticker shock, and people think of sticker shock in a negative way, but you can also have sticker shock in a positive way. So traditionally, you would hear what is happening in the world in terms of expectations. The world's growth rate is going to be Y, inflation is going to be Z. And then Jamaica would always be underperforming those, and that's the expectation when you talk about. So when I say sticker shock, the facts are Jamaica is poised to do better than the rest of the world, and it might shock some people to recognize that because, we've gone through a pandemic. As I said, we're lucky enough to have had $80 billion to carry us through it, but we have now come out of that pandemic and, we're in a much better place than a lot of other countries because countries have depleted their NIR to try and reduce inflation. Jamaica and the central bank have found a way to get the private sector to use their foreign exchange to keep the inflation low whilst preserving the NIR, the country's NIR. So we have come out, and countries now who have had to go to the IMF because they've blown the NIR for balance of payments. We don't have that problem. And because we don't have that problem, we can look forward to a potential reduction in the interest rates, as Dan has been speaking about. And this is the reason he speaks about being bold. If that prediction holds and interest rate starts to come down, it might be going up in other countries. And you're going to see numbers where for probably the first time in a long time, Jamaica would be performing better than the rest of the world and the world averages. So we're keeping fingers crossed because we think in that environment, the growth opportunity would be tremendous. And I think Jamaica will end up in a place that hasn't been in a very, very long time. So the reality, Dan, is that you can park your cash on the side and, wait and hope, or you can invest that cash and take advantage of all that we think is coming down the pike. The choice is yours.
Absolutely. Thanks for that, Gary. And I think with that, I want to close off, but I do want to remind folks that, 9 months results just out for Mayberry Investment Limited. And, two big highlights, if you don't remember anything else, is that total assets up by 18% to $51 billion. And year over year earnings up by 157% to $2 billion. This results in a EPS of $1.70 and a stock price that's trading at a PE of under 3 times. Ridiculously low, folks. Great opportunity to go out and buy yourself some Mayberry or to come in and get some advice from Mayberry on other stocks you can add to your portfolio as well too. So with that, I would like to thank everybody. That's it for today's discussions, but I'd like to thank our viewers for tuning in today. We're always looking forward to providing you with insight into what's happening in the market and with the company. And of course, your support is always appreciated. I'd also like to say special thanks to our fellow panelists, Christopher Berry, our chairman, and to Gary Parrott, our CEO. Thanks, guys, for your contributions. It's greatly appreciated. Be sure to look out for updates on our virtual investor forum by following us on social media. We share our live stream dates and upcoming guests on our social media pages. So follow us for all things forum related and click the bell to receive all of the notifications. Don't forget to subscribe to our YouTube channel, Mayberry Investments Limited. And remember, we'll be back at 6 p.m. with Lasco Financial Services today. Remember, wise investors, slow and steady